So good morning, good afternoon, and good evening, everyone. I'm Lily from JEC Berlin, and it is my absolute pleasure to welcome you to this year's International Spring Forum, hosted jointly by the JEC branches of Tokyo, Taipei, Istanbul, and Berlin. So there will now be a short poll just to see where everyone's from. And we encourage you to all turn on your camera and participate in the Q&A and breakout sessions. Just as a brief outline, this is what the schedule of the event will look like approximately. So we will start off with a presentation by Mr. Erich Müller from UBS, followed by a short Q&A session. Then there will be a breakout session for around 10 minutes, featuring young professionals from Berlin and Istanbul. And afterwards, there will be a presentation by Ms. Georgia Lee from Champ Home Decorations and a Q&A session. There will then be a short break, followed by a presentation by our last keynote speaker, Mr. Kirk Neureiter from Fidelity Investments, and a Q&A session. After our closing remarks, there will also be the opportunity for JEC members to join a breakout session to meet other JEC members from around the world, although this is optional. So at this point, I'd like to thank you all for joining us today, and I hope that you will enjoy this forum. With that being said, I'm very honored to introduce our first speaker for today to you, Mr. Müller from UBS Switzerland. He has been working for UBS for the last 12 years and started as an investment advisor for customers domiciled in Germany, Switzerland, and Liechtenstein in March 2018. Prior to that, he served in several departments, including private and corporate clients in Switzerland and the COO office for the UBS Dubai branch. Mr. Müller holds a Bachelor of Science in Business Administration with a specialization in banking and finance, and is a certified wealth management advisor by Switzerland. Mr. Müller, thank you very much for joining us today, and now over to you.
Thank you very much for the warm welcome. Yes, as Lily has already said, I'm a client advisor for UBS Switzerland. So my daily business is to advise my clients how to invest, and that's the reason why I'm in your forum today, I guess, because it's regarding global investments and how the financial markets works in general. So I quickly need to share my screen. Just one moment. Here. Can you see the screen?
Yes.
Yes, we can.
Perfect. So then, shall we start, I guess? Perfect. So first of all, thank you very much that I can participate in this event and bring you the world of UBS a little bit closer. Perhaps or mainly the goal of this presentation is to provide you with an overview on the UBS House View. What's the UBS House View? The UBS House View is the output of our globally integrated investment framework here at UBS, how we work. And therefore, I will, in the next 20 minutes, would like you to show how UBS House View is created and implemented in our clients' portfolios. If you have any questions, I guess you can write them in the chat, or we have later on a Q&A session now. So questions at the end, I guess. Or
Yes, I think so.
Okay, perfect. So to start, what's our UBS Chief Investment Office? Our UBS Chief Investment Office consists of approximately 200 researchers, analysts from all sectors, from all over the world. So we have locations in Tokyo, Shanghai, Hong Kong, New York, so all main financial hubs, as well as some emerging market hubs like Mexico City and Sao Paulo. And the Chief Investment Office was founded with UBS in 2011. And currently, there are working 200 analysts and researchers and economists all over the world to support and build an opinion on global financial markets, as well as trends. and these analysts are in total responsible for our view at UBS on the global markets, and have in the end a huge impact on our success as UBS with our client portfolios. Since its inception in 2011, the CIO Global Wealth Management Chief Investment Office has been a key pillar in our UBS strategy to serve wealthy clients all over the world. And I'm very thankful for the colleagues who work there, because I would not have the time and the capacity to monitor so closely the global markets as they do. So just for the next slide, I will leave it for a moment. That's what we believe and what our clients believe, how we see the market and how the UBS house view is in the end created. So in the end, our clients sometimes want to know a little bit more about the art behind the scenes, and now it's a time to tell you how the CIO creates our investment strategy for our portfolios. And each belief you can see on the slide is linked to an example from one of our past UBS house views, which come on a regular basis, on a monthly basis, and there we communicate with our clients as well as with me as investment advisor. And it's a chain for the investment office. So how we operate and how does the UBS house view work in the end? We have a value chain, and it always starts with determining your goals. Then we are gathering all the market experience and all the market intelligence from our analysts and researchers. And then we put all funneled information into the UBS house view to take a clear position and structure the wealth of our clients. And therefore, you see there on the, can you see my mouse, by the way? Or
yes, we can.
Okay, so you can see where my mouse is. So we have then two different allocation, always a strategic asset allocation and a tactical asset allocation in the client portfolios. The strategic asset allocation will come in a couple of minutes, and the tactical a little bit after, but it's important for you to understand how the construction of the portfolio works in the end, and that's why the UBS house view is separated in a strategic asset allocation and a tactical asset allocation. So for the strategic asset allocation, we speak in asset classes like equities, like real estate, like bonds, or precious metals like gold or silver or whatever. And therefore, you always have in the construction of a portfolio like 100% equity, which would be an equity strategy, or a 100% bond strategy, which would be a bond strategy. And you see the different parts of the pie, and this stands for the different 5 major asset classes which are known, which are equities, bonds, precious metal, liquidity, and hedge funds and private markets. And if you create a portfolio, you always decide in the beginning which proportion do you want to allocate for which asset class in the end. And then there's a little bit of a tactical asset allocation. The tactical asset allocation is really all about covering short trends, covering equities which are undervalued or overvalued, and therefore this is much short term than the strategic asset allocation. And then in the end, on the 5th part of our value chain is the decision of our clients if they want to have an advisory or a delegation role in their process. If I briefly explain the advisory is then the client, for example, would call me and ask me, Mr. Möller, Eric, do you have any recommendation how we should change my asset allocation in my portfolio to be in line with our newest UBS house view? Or if you have a delegation approach, then you do not have like this call with your client advisor. If you should change the within your allocation anything, it will be directly changed for you within the allocation. And then in the end, it's always all about risk return. So markets are changing, the history is changing, life is changing. So always look back and ask yourself, is it the right strategy? Is it the right asset allocation? And that's in total like the value chain we build with our UBS house view and how we serve in the end our client as well, or my clients. To get a little bit deeper, we start with a proper understanding of our clients' goals. You can see in the upper hand, or if I go just one slide back, it's the first step of the value chain, determining your goals, and everything is connected with a goal of a client in investing. So if you need your money, if you have enough money that you don't have to work whenever you want, so you always have to determine which money you can invest and which money you can't invest, because as you probably know, or you already experienced with Robinhood, with the meme stocks in the past year in the USA, you always have the possibility to gain and win a lot of money in the markets, but you can also lose a lot of money in the markets. So in my role as an investment advisor for clients, it's all about understanding my client, his financial situation, his personality, his needs that he has in his life, as well as the investment goal. And this is directly linked to the strategic asset allocation on the upper right box, and always more risk means more equity. So and more risk means higher return, and lower risk means lower return. So it's all about choosing you the right strategy. And this is linked to the strategic asset allocation. So on the left side, we have fixed income. These are the 6 common strategies you can choose from at UBS. Is fixed income, which always have only bonds, then income, where we add a little bit of equities, like 10%, 15%, then a yield strategy, where we add roughly about 25%, then a balanced strategy, which consists of 50% equity, 50% bonds, then a growth strategy, which means 75% equity, 25 bonds, and then an equity strategy where you only have equities. Now you see we have hedge fund and private markets. The simplest version of the portfolio is just the 2 asset classes, equities and bonds, and how you combine the 2 asset classes, and everything is on top in the end. So based on the information a client gives me, and as I understand my clients correct, I can choose together with my client the strategic asset allocation, so how much equity he wants to have in a portfolio, and how much risk he's willing to take. It's not only about how much can you take, but also how much risk will or do you want to take for a portfolio. So now we are in the second step, gathering market intelligence, and that's exactly what our researchers and analysts all over the world are for. The CIO investment office analyzes through a global network of analysts, researchers, global markets, and they also monitor them closely. So we have specialists at UBS for the equity, for the cash, for fixed income, for currencies or commodities, and also for alternatives. So we have also geopolitical analysts which studied politics to understand the change in the global politics as right now we have with the war in Ukraine, to closely covered global markets, and also for 24 hours, and that's why we have colleagues in Tokyo, colleagues in London, colleagues in New York, so that when I get up in the morning, I always have the market briefing from overnight. So what happened in the USA, what happened in Asia, so that I will be up to date, up to speed for the conversations with my clients as well. And here you can see the UBS house view, like how this all that information you can see if you switch on CNN or Bloomberg channel. There's always the ticker, and one of himself is not able to cover all the media, all the news. So we need help in our daily business to funnel the information into the UBS house view. We name it UBS house view. You can name it something different with a different bank, but it's important that we understand, or for you as well, how a bank works and how the investment office of a bank works. It's all the information funneled into one paper, which is, for example, one slide or two slides with all the important bullets, so that you can build your own view on the global markets and can decide whether you want to change something or you don't want to change something. So we have the strategic asset allocation and the tactical asset allocation, as I already mentioned before, and to really get performance out of or returns, it's all about the strategic asset allocation, how much equity you want to put in a portfolio, how much risk you are willing to take, and the higher the risk, the higher the returns. So the strategic asset allocation is mostly planned for 5 to 7 years, just as a regular business cycle has roughly a lifetime from 5 to 7 years. So it's more closely connected to the business cycle and not to short-term opportunities. This is the tactical allocation. We have short-term adjustments within the strategic asset allocation. So if you, for example, have a portfolio which consists of 50% equity and 50% bonds, then we decide for a short-term period of time, like 6 months, that we want to overweight the equity position in a balanced portfolio to probably 55% equity, because we think that the equity markets will go up for the next 6 months and then come back, and then we will reduce our allocation within the portfolio from 55% probably to 48% to be on top on the markets as well. And this is always a combination, and here at UBS we say the strategic asset allocation should be your plan for 5 to 7 years, and we allocate roughly every second year the strategic asset allocation new as well. Then we come to an example. This is how it works. That's what I already told on the slide before. I give you a minute to review the slide. So here you can see the practical example on how we changed once in 2018. A slide, the tactical asset allocation. So after 6 months, we have a tactical asset allocation view for the next 6 months that US equities have greater upside potential. So we increased the level of US equities in our portfolios for 6 months time, and afterwards we decreased it in June, that we have neutral equities in Europe and still an overweight in the US. So it's always a shorter time period for the tactical asset allocation instead of the strategic asset allocation. So how can you generate performance? I think the three drivers for the strategic asset allocation, which contributes roughly about 80% of the portfolio performance, are market timing. So perfect timing of the markets is impossible and can be very, very risky as well. And the strategic asset allocation allows our clients to focus on longer trends for like 5 to 7 years, which are more reliable than the short-term trends we see in markets. Then the second most common error when investing is emotions. So we have emotional investing, and emotional investing pitfalls can be controlled through a systematic approach with an UBS house view, as well as with a strategic asset allocation. And then we have most commonly also a pitfall for clients or for myself when I'm investing. It's all about diversification. We usually invest in things we know or we read in papers and say, interesting, I want to have, for example, AMC stock, or I want to have a Bitcoin right now, and so I will allocate a huge proportion of my assets to this one single stock or single position or single asset class. And the strategic asset allocation helps our clients and helps myself in the conversation with clients to keep in range with the goals we decided. And then we always have the tactical allocation where we can follow short-term trends like Bitcoin, like AMC stocks, to cover the one's personal need for a short period of time and with a lower proportion of the assets. And then we are already in the fifth part of our value chain, and that's whether you want to have a solution which we advise our clients, like with an UBS advice and within an advisory role. So the client calls me and asks me what he should buy or not buy currently, or a delegation where the UBS house view is directly implemented in our clients' portfolios. And then we are already on the last part of our value chain. It's keeping our clients' portfolios on track, and that's part of my job as well, that I have the spirit as well of the UBS house view, that I monitor all the investments of my clients closely and keep them on track with our latest UBS house view as well. So with that, we have one slide left, and this is what's the end or what's the outcome of our UBS house view, and what's what is it for in the end. And we see that within UBS Manage, which is the delegation version of UBS, only 8% of non-contracted client portfolios have outperformed UBS Manage over the period from 2013 to 2018, so over a period of 5 years. And why is that? It's mainly or mostly the case that clients have too are too nervous to hold on to their strategic asset allocation and accept the fact that sometimes you have to stay put and do not sell any stocks and wait until the markets go up again. And that's why the structured approach with our analysts, with our strategists, is for most, I say most of the clients, the best option to invest, diversified all over the globe. So with that, I guess I will hand over for questions.
Thank you very much for the presentation. This was very informative and very in-depth. I have one question that I think would be relevant for all of us. Since we are high school students, I think it would be quite relevant for us to know what steps we should take to, for example, become a part of UBS as a market analyst. For example, what fields of study are relevant, or what experience and skills are required to actually start working in this field of global investment?
It's a very good question. I think you all are interested in the economy, in global markets, so that's the first step you need to have. And if you study physics or mathematics or business administration with specialization in banking and finance, as I did, I guess that's not so relevant. You also can study biology. We have one of my colleagues has a PhD in biology and now has the same role as I do. It's all about keep up with the global news, with global markets, do your studies, and then be open for such a position, and do probably, and there are a lot of summer internships you can do at banks or at the insurances as well, and other internships, and that's the best way to get in. But the most important thing, keep up to date with global news, with global markets, and keep interested in it. And it's not about which equity does what or which company does what. It's just about the personality and the spirit you have, that you are interested in the global macroeconomics as well, I guess. Is your question answered, or
yeah, that answers.
Okay.
Yes. Who that
was? It was Jasper. Yeah. So I have a question. So you here have like 5 phases, right? That you do before you start investing or create a portfolio with UBS. I was wondering, I think this would be strategic assessment. I'm not sure. Is there also always a plan included for when things don't go the way as planned? Like, do you also like in advance decide how much loss you're willing to take, or is it just how much risk you're willing to take?
The risk is linked to the loss in the end. So we in finance you usually talk about risk and not about loss, but the risk of a strategy, of a strategic asset allocation, is directly linked to a potential loss you are willing to take. So, for example, in an equity strategy where you have 50% in equity, 100% in equity, sorry, the empirical studies show that you usually, in a market stress scenario, as in 2008 with global financial crisis, and probably for 2 years, 2020, where we had the coronavirus and corona pandemic coming up, you usually lose for a certain time roughly 50% of your portfolio, and then it's whether you are selling, and if you sell, you have the loss in your pockets, or if you have the time to sit it out until the markets go up. For coronavirus, it was roughly about 6 months. You had to wait until the stocks were there again where they were before. So it's not about the loss you're taking. It's about the risk you're taking, which is linked to potential losses. And a loss is only then a loss when you realize the position. So, but yeah, it's true. With a risk of 100% equity, you usually have 50% downside risk for a time horizon for roughly about 6 to 7 years. It depends on euro, dollar, or yen in the end. And with a bond portfolio where you place 100% in bonds, you have a downside risk from roughly about 7 to 8% for a time period of 2 years. And for the middle like balance 50-50, you should have 25 to 30% downside risk, so loss risk, for a time period of roughly about 4 to 5 years. So that's something I discuss with my clients for sure.
Okay, thank you very much. Actually, sort of one then follow-up question. For example, in like a sort of like crisis situation, like let's say the invasion of Ukraine, when the Russian ruble lost a lot of its value. Let's say there is a client who has like a part of their portfolio invested in this currency, and the analysts at UBS find out, oh, there's something going wrong here, like it's losing a lot of value. Do you always need to discuss this with the client first, or does UBS take action with this like immediately? Or then, as you said, it could also be that you like just keep holding on to it. But
it depends. There are like two servicing models of our clients. We have the delegation. I'll just go up over here. Yeah, exactly. So we have like the delegation version in the under part of the slide, and the advisory business in the upper part of the slide. And within the advisory business, it's my job to call the client you described and tell him, lovely client, we have a huge position, for example, in Gazprom. Gazprom will be sanctioned. We will not be able to sell the stock at the market. We quickly have to sell it right now. And then the client can say whether he wants to sell it or he wants to hold on to the position. And within the delegation part, that's there where the UBS House View is directly implemented. So if a colleague, for example, in Tokyo or in Shanghai finds something, then he will call up all the colleagues of him and tell, we have to change something. And when I get up in the mornings, I will see the change in the portfolios of my clients as well. So there you have a direct implementation of every decision which is made within the UBS House View.
Okay, that makes sense. Thank you very much.
Thank you very much for answering all of our questions. Unfortunately, we are running out of time. So while we still have a few minutes, I would like to, in keeping with JEC tradition, I would like to ask you one question that we always ask all of our speakers. What would be the one key piece of advice you would give to us high school students today?
One key advice in terms of markets, or in terms of advice for.
In terms of anything, if you would like to share some advice on the markets, you could also do that.
No, no, I think it's that what I said in before already. Keep updated. Keep interested in global decision making, in global news flow, and then you will have a beautiful career, I guess, in finance. And it's Sunday morning, and we have, I guess, 40 participants. So when I look back at my age, when I was 18, I wouldn't be part of a forum like this in the Sunday morning. So I think you all got what it takes in the end.
Thank you very much.
Thanks.
So thank you very much again, Mr. Meller. Our young professionals have joined the Zoom meeting, so we will now start the breakout sessions. Yeah.
Perfect. Thank you very much. Bye.
Thank you. Bye.
Okay. Hello, everyone. Welcome back. I'll now hand over to Eric from JEC Taipei to introduce our second speaker for today.
Hi, my name is Eric, and let me introduce our speaker of JEC Taipei. And her name is George Lee, and her position is the manager of Chain Home Decoration. And this position requires her to understand and to be able to keep track of the market, since it is a trade-related business. And moreover, she started some personal investigation for a while, and she was able to combine her previous knowledge on it. So I think it's enough for talking, and let her to start.
Okay. Hi, can everyone hear me right now? Hello?
Yes.
Okay. Okay, good. Hello, everyone. Thanks for joining this sharing session. I'm Georgia Lee, sales manager of Chain Home Trading Company. So obviously from my job title, you could see that I'm super relevant to stock investment industry. Actually, I'm just maybe like most of you here, a newbie, a beginner to this area. So I would have to say that today my main purpose, my main goal is to share my personal experiences about how I start my investment plan and what I've been through, what my mentor told me, and maybe some, useful resources with you guys. Okay, so comparing to previous sharing, my sharing could be a little bit more relaxed. So feel free, if you have any questions, just type in the chat box. Okay. Okay. So right now I'm going to share my PowerPoint with you. Okay. I assume that you can see my PowerPoint right now.
Yes.
Okay.
All good.
Yes.
Okay. So, okay, let's get started. As a beginner to stock market, just like me, okay, I would say that the first thing all of my mentors once told me is about that the first thing you have to do is to sit down for a while and really think it thoroughly about why you want to do this, why you want to get into stock market, and why you choose a stock as your investment tool. Also, what is your goal and purpose? These questions are really important for all of us to think it through before we start our investment, because by thinking through all of these questions, then it will help us to build up a very, very strong mindset. Okay. Why we would say that our mindset is so important and so crucial in this industry, because we all know that, in real world stock investment, it's kind of like a money game, or we should also say a mind game. And, from all the books, from all the movies, you could probably know that people could easily get lost in a money game. So how can we help ourselves not get lost during a money game? Then we have to build a very, very strong mindset to help ourselves to survive from this game, okay? So what are those mindsets? Okay. The first one is, please keep your consistency, okay? Consistency is very, very important to beginners, okay? Which means that as a beginner, you can choose whatever, all the theories you want to believe in. You can believe in fundamental analysis or technical analysis. Choose whatever you feel comfortable with. But the most common mistakes that most beginners will make is they probably will listen to Index A today, but also believe in Index B tomorrow. Please don't do that. This will get you, easily confused about all the stuff, okay? As a beginner, all you need to do is to find a good way of good methods of investing, of your investment, and then, or a good principle to follow us, and then execute it, practice it, or follow it faithfully, religiously. Okay, because eventually time will tell you that everything, all the practice, all the experiment will eventually pay off, and time will tell you that being consistent all the way is actually the most effective way to help you maximize your profits and minimize your losses. Okay, so lesson 1, please keep your consistency. And the second one is actually more difficult for all of us, is overcome your fear and desire, or I should say that insatiable desires, because, face it, we're all human beings. So it's inevitable that you might get a little bit frightened when you first call in or log in to purchase your very first stock for yourself with your own money. And it's also very natural that we might get a little bit greedy when we see our stock price keep climbing and climbing. Then you probably don't want to leave at the right moment. But it's all human nature. We understand that. So that is why my mentor says that at the very beginning, we have to set up our goals and purpose very clearly. Because by setting up these goals and purpose, then you will know how to set up your profit gain points and profit taking points. I should say that profit taking points and lose stop points very firmly. And you can leave these points without pain and hesitation. And that's also a very effective way to help you maximize your profits and minimize the losses. Okay, so here are 2 very, very important mindsets to share with you. Easy to say, but hard to execute, actually. Okay, once we set up our mindset, what should we do next? We should still develop some basic concepts for our investment plan. These are all basic but accurate concepts, and we should keep, reminding ourselves day after day, because it's still not very easy to execute, actually. And lesson 1 is control your emotions. When we say control your emotions, we mean that as a beginner, please don't listen to or don't believe in those unproven news or messages from, no matter it's TV news or, a friend of yours, your neighbors, your colleagues. Don't do that. My mentor told me that as a beginner, all you need to believe in is charts and data. Please just do your research, do your study on charts and data. Because charts and data, they don't like human beings. They don't have emotions, and they only reflect pure, facts. And we have to know that in stock market, stock price will only reflect like future information, future trends, future phenomenon. So what's happening right now, what you hear right now, sorry about that, they are all past tenses in stock market. So kind of like useless to, stock purchase. So please still do your research, do your study about data and charts, okay? And lesson 2 is about cutting losses, okay? Cutting losses is also pretty similar to controlling your emotions. We should say that like from the history of stock market, we can say that like no one, literally no one could be 100% right about the market or could always win from the market. So since no one could always win, so by the time when you realize you are losing or you are about to lose, what should we do? We should leave without hesitation, okay? Okay, so like I could share one of my mentors says that he said to me that, girl, you can fall in love with your stock, but don't get married to it. Please leave when you should, okay? So that is how to minimize your losses, okay? And lesson 3 is increasing your winning rate. Okay, let's put it this way, like if cutting losses is a way to help you minimize your losses, then increasing your winning rate is the real method to help you gain profits from the market. Like we said, no one could 100% to write about the market. So sometimes you can win, sometimes you can lose. But we have to say that to be honest about this part, that there is no shortcuts for this part. You really have to take your time and energy to do all the practice, to do all the experiments, all the research and study to increase your winning rate, step by step. But a fun fact so we can share here, from the real world, that actually the ideal winning losing ratio is 3. Okay, not 1, not 2, but 3, which means that if you lose like 10K from stock A, but if you can still find a way to win like 30K from stock B, which means that your ratio, you reach the ratio 3, right? Which means that you are still very, very professional in this stock market comparing to most people in this market, because you know what? Most people in stock markets, their winning losing ratio is about 1 to 1.5. 2 is considered pretty good, but 3 is professional actually, okay? So take your time, energy to increasing your winning rate by keep practicing, okay? And the last but not least is protect your capital. Always remember, no matter for what all kinds of investment, please remember this is the bottom line, to protect your capital, okay? Because this is really important, because in real world, we still need to survive after even the market collapse, we still need to survive. So I should say that this should probably be lesson 1 actually, but we will share more details about this part later. Okay. So once we set up our mindsets and develop some basic concepts, what should we do next? We can start to pick our stocks, okay? Before we pick specific stocks for ourselves, I would say that as a beginner, we still need to read the market trend first to understand the market trend first, okay? And words to the beginners, please always get into the market while it's bull market, okay? And can I ask, does anyone know that what does bull market mean? Anyone want to answer this question?
That's when stock prices are rising?
Yes, means a good market for investors to get in. Yes, correct. So on the contrary, I should use this image. Okay, on the contrary, when the market is bad for investors, we call it bear market. Okay, and does anyone know its origin, why we call it bull and bear? To represent good and bad markets. Okay, I can do a brief introduction here. Okay, in the past, people think that they can eat up and use every inch of an ox. So they view ox as a symbol of wealth. Okay, and in past, people also think that the horns of an ox could lift up things, including stock price. So they said that if the market is good, it's burgeoning, then we call it bull market. So on the other hand, why a bad market is bear market? Well, it actually originated from American frontier period, that during that period, cowboys, they always pick a bear to bullfight with an ox. So you can imagine that if the horns of an ox could lift up things, then the paws of bear could press down things, including stock price. That is why we call them bull and bear markets, okay? So just basic information for everyone to know. So it's safer, always safer for beginners to get in while it's bull market. But still, you need to read the charts and data to decide if right now is a bull market. Don't just listen to the messages around you, okay? And then the second step is to pick the stock, okay? Before we pick certain stock or specific stock for ourselves, we need to pick the certain industry for ourselves first. So I would say that when you decide your industry to get in, still need to read the macro trend of the market. Like, for example, like right now during the wartime, okay, you can see that probably technology, information, medical, financial, or energy industry could be more favorable industry to get in. Yep, something like this, okay. So still we need to read the macro trend and find a favorable industry to get in, okay. Once you decide your industry, then we need to pick specific stocks for ourselves, okay. So here we provided two important indicators for you to look at. The first one is EPS. Okay, we list its formula here. Okay, EPS is actually short for earning per share. Pretty self-explanatory, right? It's the profit that the company is willing to share with their stockholder. Okay, so it's purely about profit. So we can do a little test here, okay. Like here, we list like two companies' performance within 5 years. So stock A and the stock B, okay. We listed their stock price and the EPS ratio within this 5 years. Can you tell that which one is a better target to invest in? I think it's not a very difficult decision to make, right? Okay, I would just say the answer. The answer is stock A, okay? Obviously, you can see that not just because its stock price is increasing year after year, which is very promising, of course, but the most important part is about the EPS ratio. Okay, you can see that the EPS ratio is also increasing year after year, though 19 Q3 to 20 Q2 probably was impacted by the pandemic, the COVID situation a little bit, but it bounced back strongly next year. So obviously, this is a very strong, very steady company to invest, okay? And comparing to stock A, let's look at stock B, okay? You can see that not just because its stock price is not that stable, not that promising, but also the worst part is about its EPS ratio. You can see that the EPS ratio is diminishing, is declining, okay? They're not willing to share their profits with their stockholders. So this is really a bad sign for investors to get in. So really easy to read these indicators, but it's also very important indicators for beginners to observe, okay? And the other indicators we can share is MA. And what is MA? Moving average, okay. MA means the average stock price within a certain period, okay? So when we say like 60-day MA means, okay, average stock price within 60 transaction days, okay, which is about a quarter because, you know, stock market is closed during the weekends, okay? So when we say like 240-day MA means yearly average price, stock price, okay? So we can also do a little test here, like this line obviously is the stock price of a company, and the yellow line means 60-day MA. The purple line means 240-day MA. Do you think that from this chart, do you think that this is a good company to invest in? The answer is yes, yes. How should we say, how can we see that? Okay, obviously you can see that the stock price of this company is like all the time above the MA, which means its performance is superior to most company, most stock in the market all the time. So this is a good sign to investors, means that this company is growing and performs superior than others. Yeah. And also another takeaway for the beginners from my mentor is that always remember, don't purchase a stock when its stock price is below to 40-day MA, okay, yearly MA, okay? So this is a very important but basic indicator for us to observe, okay? When it falls down here, don't buy it, okay? All right, so two important indicators, okay? And except for all the charts and data, I would say that to me, I would still study a corporate culture and its management philosophy. I would see their policy, their strategy, because I still care about our society. I still care about our planet. You can, read the magazine articles or, study their website to see their strategy. If you think they are not ethical enough, they are not doing good to our planet, if you don't feel comfortable about this company, then don't invest in them. Okay, so I think that's the last thing I would say about picking your stock. Okay, so after we pick certain stocks for ourselves, okay, we can start to put our money in. So how should we put our money in? It's about capital management. Okay, here we would also provide a very simple principle for beginners to begin with. This is a capital pyramid, but sorry, this is not a professional term for investment. We just invented this term for today's sharing, but this is actually a very useful but very simple principle for all beginners to follow. Okay, the first thing is that always remember, no matter what happened, always remember, no matter how flourished the market is, reserve 20% of your capital for all kinds of emergency, because no one knows what might happen tomorrow. And the market could collapse tomorrow, okay, or maybe there will be a huge earthquake tomorrow. We never know, so we still have to survive. So please remember to reserve 20%, but you can definitely adjust the percentage a little bit by your own choices, but this is just the principle for you to follow. And for the rest 80% of it, we would say that use half of it, like 40%, to build your mother stock, okay? Mother stock is kind of like a mothership of your whole investment plan, okay? So the principle about how to build your mother stock is kind of like purchase your mother stock at a very moderate pace, or purchase low risk stocks, because it's safer for beginners, okay, since we don't have lots of experiences about this part. And when we purchase our mother stocks, please don't just put in like for all 40% all at once. No, this is the wrong thing to do. Please just do it like gradually, step by step. You can put like to stock A, like 20% on stock A, 10% on stock B, 5% on stock C, and the rest of 5% on stock D to do the risk diversification. Okay, so I think it's pretty easy to understand. And for the rest 40%, it's in the free zone, but still execute it cautiously. We would encourage you to do all your practice and experiments in this free zone, because if you execute these two process properly, no matter what happened in this zone, you can still keep like 60% of your capital, and you can still survive no matter what happened here, and you can still start it over again, even you lost all here. Okay, so that's just a very simple plan and the principle for everyone to start with your investment plan. Okay, and for today's sharing, I would say that though we know that this is a money game, but since stock market has developed for hundreds of years, so in the long run we can still see its rules, and we can still observe some signs from all the charts and data. But I'm afraid that for today's sharing, we probably don't have enough time. I plan to share some practical skills about how to observe those signs from the charts and data. to all of you here, but I'm afraid we don't have enough time because it might take you another like 20 or 30 minutes to see that. So maybe we save it for next sharing. But before we end up this sharing, I would say that I would conclude my sharing is about these two conclusions. The first thing is to protect yourself. And it's super, super important because like I said, we all need to leave no matter what happened tomorrow. So please do it cautiously and do all the work and do all the research before you get in, okay? And the most important part is we know that we get into the stock market is trying to pursue wealth. But before we do that, we have to know what's the meaning of pursuing wealth to you. Okay, I hope that everyone can bring this question back home and think about it before you start to do your investment, because to me, this is really, really, really important to think about. That you would know what you are doing right now, okay? So I guess that's all of my sharing today. Not very hard, not very difficult to understand. And any questions about my sharing?
May I ask a question? Like, what is the biggest difference for your strategy and the real invest in your experience?
My strategy comparing to real investors.
Yes,
right?
the real investment experience. Like, if you expect the stock market will do something, but your strategy has some difference. What is the biggest difference in your experience?
Okay, because like I say, I'm still a beginner, I'm still a learner in this area. So I would say that my strategy, the core of my strategy is to be conservative about that. Because I'm not like super wealthy. I'm not like a boss or owner of a company. I can take any risk, to lose my house, to, have more debt under my name. So I would say that for me, to me, because this is also the first year to me to get into this to this area, to this industry. So to me, I would say that I would always play it like conservatively. Yeah.
And do you also another question, like, do you encourage a senior high school student to invest in the stock market, or you think we should focus on the study?
I would say that if you are super interested in financial management, yes, you should do that. But maybe, limit your amount like to a very limited amount, just kind of like do it, like kind of do like a project experiment to see how you learn from this market and how you feel about doing your very first investment. Yeah, if you are very, very interested in this area, yes, I would say that. Yes, do it as soon as possible.
Okay, thank you.
Thank you. Any other questions?
I have a question, because nowadays I think there are many people who are more and more invested into the stock market, and I think this industry is like growing very rapidly. What do you think is the most accessible or like platform for us high schoolers to invest in or start to invest in stocks?
Yes, I would say so. Yes, definitely. But if you want to play it more conservatively, I would also recommend that you can do like, you can start with funds, rather than just, put all your capital in stock markets. Funds could probably a safer choice for students Yeah, and I also know that actually lots of high school students and college students, they also started their investments in from Bitcoin. Okay, I don't know if anyone here is interested in this topic, but I know that lots of people are doing this right now. So yeah, I would say that for students who are really interested in financial management, they probably don't, they are not afraid to take risk, you know, to do all the experiments. But still, I would say that maybe just take a part of your capital to do all kinds of experiments and control your losses. But based on this principle, I would say that all kinds of investment you can try on if you feel comfortable about that. Yeah.
I'm sorry to interrupt. What I think Leon was asking, correct me if I'm wrong, but I thought he meant what platform what platform would be the easiest to understand for high school students, as in what type of digital tool, like an application, or what software we would need to actually start investing.
To start for stock market, or
yes,
for stock market apps. Because I only invest in Taiwan stock market, not like to global stock market. So I would say that to me, actually, I start my investment from reading books and magazines, because honestly, I met a few professional analysts and consultants. They are really professional people in this industry, but do you know what's the first step that they recommend me? They recommend me to start with reading books about stock market, to know the truth about stock market. So this is my first book with all my notes here. Okay, so I would say that all kinds of apps could be very useful and resourceful because they provide different information, and I think people would need, different people would need different information to help them to decide which is the best stock for them to purchase. But I would say that before getting to, some digital platform or, apps, using certain apps, you can try to, start with reading some relative books to start with it. Yeah, but all kinds of apps I would recommend. Yeah.
Okay, thank you.
Thank you.
Just a heads up, during my session, I have 3 book recommendations for you at the end of it, so stick around for my session.
Okay.
Thank you.
Thank you. Well, if there are no other questions, thank you so much for your speech. I think we all have a lot to learn from your insight. And yeah, thank you so much.
Thank you. Thank you all. Bye.
Thank you. Thank you.
So, okay, now I would like to introduce our final speaker on behalf of JEC Tokyo, who is Mr. Kirk Neureiter. Mr. Neureiter is the president of Fidelity Management and Research in Japan, as well as a portfolio manager in the Japan Equity Division. Today, he is here to talk a little bit about his career in the finance industry, as well as a little bit on savings and the question of why we should invest in equities in the long term. So I'm going to share my screen now, and Mr. Neureiter, I'll hand it over to you.
Great. Thank you. Good evening, everyone. I'm glad to be here with you. I'll talk, again, I always think interactive sessions are better than one person speaking at you. And it sounds like you've had a little bit of an introduction to investing in equities. So I'm happy to take your questions later on for that, but just a little bit of my background. I was actually born in Germany, but I'm an American and Irish citizen. Lived in a bunch of different places, mostly due to my father's work. He was in the State Department for the US, and then worked for Texas Instruments, both in France and in Japan. He's part of the reason I'm here today in Japan. Went to high school in Texas, went to university in Ohio in the US, and then moved to Japan right after graduating from college. I had 6 years in Boston after being here for a while, and then moved back to Tokyo 8 years ago to take on my current job. Just switch over to the next page. So when I first got here, I started studying Japanese for the first time. And after a year, I joined Sony Corporation, working in their consumer products division. And at the end, I was actually doing consumer product sales into Far Eastern Russia, which was a really good experience. But it also is part of the reason why I changed industries to Fidelity Japan. I joined as a junior analyst and started covering small caps, hotel sector, textiles, pharmaceuticals, chemicals, and then I became a manager of a Japanese fund. This is for institutional investors. I'll get into that a little bit later, what that is opposed to an individual investor. Then I moved to Boston to work as a global analyst on large cap stocks. And then I moved back to Japan in 2014 to take over the Fidelity Japan Fund, which at the time was about $350 million. Today it's about an $800 million fund. Then a couple of years ago, 3 years ago now, they asked me to manage the Fidelity Pacific Basin Fund, which we invest in stocks from Japan to China to India down to Australia, so the entire Pacific Basin region. So combined, I manage about $1.6 billion out of our office here in Tokyo. I have a group of 7 analysts who are based here, who support me on Japanese stocks as well as stocks around the region. And then we have a team of 17 analysts based in Hong Kong who cover both Japanese stocks as well as companies all around the Pacific Basin. If you switch to the next page, please. So a little bit about Fidelity Investments. I believe this group has had a presentation about the asset management industry in the past. Is that the case?
Yes, we had a presentation from a speaker at UBS, Switzerland.
Yes. So Fidelity Investments is one of the largest investors in the world. We're significant players across different asset classes. It was started back in the 1940s by Mr. Ned Johnson, and the Johnson family still owns it. His daughter is now the president and chairman, or his granddaughter is now the president and chairman, a woman by the name of Abby Johnson. So her family and the employees are the main owners of the company. So we manage about $4.5 trillion in assets for 40 million individual customers, and about 23,000 businesses also give us their money to invest for them. And there are 155 investment professionals. Those are analysts and fund managers based in Boston, Tokyo, Hong Kong, and London, trying to identify investment opportunities around the world. And you can see down below there, we have about $2.5 trillion in stocks. $2 trillion of that is in the United States, and $500 billion is invested internationally. I'm based in Japan, and we have about $35 billion invested in the Japanese stock market. We also have bonds, high income, and money market funds, significant assets. Now, you can see down below in summary of what Fidelity does. We're a solution provider. We will give clients what they want in terms of exposure that they want. So I think you heard from Momo earlier about being a conservative investor, and we can provide a solution which is quite conservative. We can put more fixed income in your product. We can put international equity. We can put large cap equity. We can put more money markets in it. What a lot of people want today is a solution instead of just buying a stock or a stock fund or a bond fund. And so Fidelity, because of all our specialties, we're able to package different solutions for people to give them the savings option that's best for them. Because this is something I've always believed throughout my career, which is, I guess I've been at Fidelity since 1994 now, so about 26 years. That when you're investing your own money, what's probably most important is being able to sleep comfortably. When you're young, you know, it's all exciting and challenging, but as you get older, you realize how precious those assets are. And your time starts to diminish as you get older. And your ability to recoup losses also goes down as you get older. So being able to sleep comfortably, knowing what you own, and being able to plan it out over the long term is very important. Why don't we just switch over to the next page? So just quickly on saving. What is saving? Individuals, you're essentially doing it because you're deferring large purchases now for large-scale investments or purchases in the future. And if you can't borrow from either your parents or from a bank or from a friend, you have to save yourself to acquire these things. Now, it's even harder to do it when you're just working from a salary. Depending on your income level, tax eats away at your annual income. And in certain tax brackets, you're getting taxed at between 40 and 50%, depending on the country. Some countries have even higher tax rates. But when you're starting out, the big expenditures are furniture, car, a home. As you get older, college for a child. I'm putting a child through University in the States right now, and that costs $75,000 a year. And that's a big outlay. I started saving for her when she was born. So fortunately, I've had 18 years of investment history when the market was doing extremely well, and her education is paid for. These are some of the big investments that you pay for earlier on. If you're trying to start a business, you need to start saving early. You also save for emergencies because you never know when you're going to be sick, you're going to have an accident, job loss. And then last, as you get older and older, retirement. If you're going to stop your job, if you want to retire early at 40, if you want to retire early at 35, you got to start saving now because every year you're going to require that money to be able to live. Now, after individuals, you look at companies, why they save. What are they doing? They need to save if they can't borrow enough to expand production of whatever they make, whatever service they provide. They need to save if they're going to try and make an acquisition of a competitor. They need to save if they're going to try and buy back their own stock, or they need to pay out retirement benefits to older employees. There's another group, charities or nonprofits. These are things like hospitals or churches or charitable groups, say for the homeless, many different charitable institutions. People give them money and they can't spend that money all at once. And so they build up these funds to invest and earn money for them to pay out benefits in the future. These are big clients of ours, and it's essential that they be able to earn money on that retained earnings. So how do you expand that pool of savings? And really investing is the only way to generate returns greater than, and hopefully the most important, depleter of savings, and that happens to be inflation. So, when you go through all the options, the most important thing is that your investment is that you're able to manage the risk first, but then being able to beat inflation over the long term is the second most important thing. Let's switch over to the next page. So as I mentioned, you got to use the power of the market and others to work for you to beat inflation. You are racing against the loss of purchasing power because of inflation. Now I'm going to go back a little bit further in time. So over 50 years, inflation has averaged between 3 and 4%. We've had a really nice period here over the past 10 years or so, where interest rates and inflation in the United States and globally has gone down a lot, and it's led to a lot of appreciation of markets because interest rates were so low. But now we're starting to see that change a little bit, and prices, first off in the United States, are running between 7 to 8% on an annualized basis. That's the CPI, that's a consumer price index. Now, part of the reason that the US is at the forefront of this is because they've been recovering a little bit faster than the rest of the world from Corona. And so the economy's been accelerating, and there's a lot of money in the system because of the stimulus provided by the central governments. Now that inflation that we've seen in the United States is starting to spread into Europe. You're seeing a lot of energy price inflation, and that's going to flow through to other parts of the economy. When you start to see the CPI appreciating too quickly, interest rates are going to start up, and your purchasing power is starting to be depleted unless you can invest at rates which exceed the rate of inflation. So for investing, let's go through your options. First, you can stick any money that you've saved under your mattress. This was an extremely popular strategy in Japan because they were so fearful of the markets or putting in any place else when the bubble popped in 1990. But you get zero return. You're going to lose over the long term 3 to 4% of your purchasing power. Just an example of things that go up over time. So when I was in high school, price of gasoline was about 75 cents. Prices now are in excess of $4. A can of Coca-Cola was 35 cents. Now in the United States, most Coke machines will sell at around $1.25. So if I had had $1 sitting under my mattress for the last 30 years or 40 years, I'd only I wouldn't be able to buy one can of Coke, whereas I was able to buy 2.5 in the past. You can deposit in the bank at some interest rate, but that's generally less than the rate of inflation. It's very, very low risk, very low rate of return as a result. You can buy foreign currency for a higher interest rate, but there's greater risk of it depreciating against your own currency. Now, the second one I mentioned here is crypto. Crypto is a really hard one to talk about because there's very limited history in crypto. So it's really hard to say if this is investment, a store of wealth, or it's speculation. And I'm sure everybody has an opinion about it. And I'm sure people are making money on it because the price keeps going up. But I've never heard anyone be able to really tell me what's it worth. They always say, well, more people are going to buy it, so it's going to go up. Unfortunately, there's a ton of different cryptocurrencies out there, and more keep coming. Obviously, Bitcoin and Ethereum are probably the most well known. But it's really hard to say where it's going to be in a period of 5-10 years, and that's how you really measure sort of the durability of your investments and try and predict what rate of return. And so perhaps holding a percentage of any asset you have in crypto is one idea if you care to speculate, but it's really hard to predict what that might be worth at some point in the future. Maybe a basket of cryptocurrencies is one way to get exposure. Another one is gold, which is always perceived as the currency of last resort because everyone will accept it. Every country in the world, they used to base their currencies off of it, but it moved away from that and more towards fiat currencies. But it's very tradable. There are high costs of exchange, so it's not great, but it doesn't generate anything. It just sits there. Warren Buffett, if you've heard of him, he said one great thing about gold. What if you bought up every piece of gold in the world and you melted it all into one giant block? What would you do with it? You'd have to hire a bunch of guards. You'd put it in a gigantic vault and you'd sit there and look at it. But nobody else would be able to buy it off you because they couldn't afford it. And it wouldn't generate anything for you. So it's, again, it's sort of speculative in a sense that at some point it will be tradable, and a lot of central banks own a lot of it, but it's hard to say what it's really worth. Some of the things like collectibles, these are jewels, art, wine, etc. Everybody says, oh, they're such great, but there's a lot of friction costs when you put it at auction to sell it. You have to pay big commissions on it. So unless you hold it over a very long time, it's very hard to recover those costs. Bonds, they're very liquid, very easy to trade, but the rate of returns are, if the high yield bonds can get you 6 to 7%, but they're more risky because their potential bankruptcy of the company is higher. But government bonds, longer term government bonds, around 4%, and short term bonds are between 1 and 2%. So again, you're still battling against inflation, especially when the CPI is at 8% currently. Property, it generates some rental yield, and there is some speculative element to it when things get great, but it's more like a bond than it is an equity. And lastly, stocks or equities. What's great about equities is that when you buy something, you're buying a piece of a company. And a company is something that has the potential to earn significant rates of return if you're choosing the right one. It also has the ability to grow, something that a bond doesn't do. It just pays you out a certain amount of interest and never grows. The principal never grows. With equities, $100 investment in a stock, that will grow. Let's say it grows at 10%. The following year, if it grows at 10%, it's growing on a base of 110. And that continues to compound over time. And when you think about the potential of a long-term growth over time, long-term growth company over time, and the ability for those earnings per share to grow up and the value per share to go up, it's just massive, the potential if you get your investment right. So this is one of the reasons why I've always found equities to be the most profitable investment over the long term. Let's go to Aisha, how are we doing on time? I just want to be conscious of everybody's time. Are we on schedule? I've got about 8 more slides and I can get through them relatively quickly if we're tight on time.
Yes, no, that shouldn't be a problem. Arnas, we should be good on time, correct?
We're on time. We're definitely on time.
Perfect.
Great.
Should I move on to
All right, so please go over to the next slide. So this is a comparison of returns of different asset classes over time. And can anyone read the starting date on that? It's too small for me at this point, and I can't explain
1988.
So 1988, this is a relatively short-term history for most people when you go back and think of things, but I'll show you some different statistics later on. But equities by far and away have been the best performing asset over time. So the equity line, this is US large stocks, the S&P 500 in the black on top. I believe long-term government bonds are the second line in red. International stocks are the third line in blue. Real estate is in purple, and gold, I believe, is gold. And then the green is short-term treasury bills. And then the last gray dotted line is the rate of inflation. So this is just one statistic highlighting how far superior the equities have been to the other asset classes that I was discussing. Again, crypto has seen phenomenal returns. When I lived in Boston, there were ATMs at the train station downtown where I could have bought Bitcoin for around $75. All I had to do was put my credit card into the machine, and here we are at what $43,000, I think, for a Bitcoin today. So I've been accused of being stupid by my son, and I put my hand up, but I just didn't know what it was worth, and so I tend to be a little more thoughtful rather than just putting out there, because I think someone else is going to spend more money. So I'm still studying it. I've been studying for a long time, and I still don't 100% get it, but I'm trying to get my hands around it. Let's switch over to the next slide. So what's really important to understand about stocks is the value of those stocks tend to rise with the earnings that they generate. So the line on top is the market average, I believe the S&P 500. The middle line are the earnings of all of companies in the S&P 500. And then the line down at the bottom is the valuation, what the price to earnings that you're paying over time. And then on the right-hand side, you can see this is between 1900 and 2020. These are the long-term returns of the stock market. So over all periods on a monthly basis, market average has gone up by 80 basis points, or 0.8% a month. During bull markets, up by 1.5%. And then during bear markets, this is when it's been down over a significant period, typically 2 quarters in a row. They still go up, but only by 0.3%. And you can see the annualized change below that, 10.2%. And then during bull markets, when you're seeing multiple expansion, it's up by 19.5%. But again, look at the statistics down below. By buying and holding over a longer period, on average, you're going to be up every single year, even when you're in a period of weak markets. So that's how compelling owning stocks over the long term is. Let's go over to the next page. one of the reasons why stocks are so compelling is that they continuously generate a free cash flow yield. So the S&P, the line on the top is the total return. The black line on the bottom is the free cash flow yield. This is the free cash flow divided by the market cap of the company. And you can see that broken down between dividend and stock buyback below in terms of how they're returning that free cash flow to shareholders. So you're at certain times, as you can see in 2009, during the Lehman shock, when the markets collapsed, the free cash flow yield was significant, and it made it a really attractive time to buy stocks because they were so cheap. And you've seen very big multiple expansion since then, with the free cash flow yield going from 11.5% down to 4.3%. But they're still yielding in excess of most other investments, which makes them still pretty compelling. Go to the next page, please. This is the yield of what you're getting on different government securities. So you can see how that has been coming down over time as well. This goes back a long time in history, since 1928. Interest rates spiked quite a bit in the late 70s, in the early 80s, when we saw quite a bit of inflation. And the chairman of the Fed at the time raised interest rates significantly to knock back inflation. They've been falling ever since. And that's why equity investments have been so powerful, because if you're familiar with discounted cash flow, as you lower your interest rate hurdles, the value of stocks go up significantly. The value of free cash flow being generated by companies goes up significantly, so the share prices are worth that much more. So it's been a great time to be an equity investor in the past. Let's go to the next page. Now, I'm going to talk a little bit more about stock picking at an individual level. So I'm a growth investor, and these are the things I look for when investing in a company. First, I try and understand their product or service. What is the barrier to entry to that product? What is its competitive advantage? Are they growing their customer numbers? Are they able to raise prices? If their product is so good, certainly they can charge a higher price. If their prices aren't going up, why not? And what's happening to their profit margins? Secondly, I try and look at what the potential market size, or it's called a TAM, total addressable market. So what market share does a company have today? So let's take a company, for example, hopefully some of you know, a company like McDonald's. They might have 20% of the fast food market share in the world. Can they go to 30%? Can they go to 40%? Or are they at 20% today, and are the competitors getting tougher and tougher, and they're only going to be at 20% 5 years down the road? How fast can that grow, depending on how much market share they can take? So understanding what the potential is for a company to grow and how fast that potential is. Because my goal as a growth, I'm trying to understand how much profit this company will earn in the future, whether it be 3 years or 5 years. And then I try and decide what's the right price for that company. The next thing on the list is their profit margin. How much profit can they earn for every $10 of sales that they generate? Is it $1? Is it $3? Is it $5? With software companies, it can be very, very profitable because all you have to do is have a programmer who writes some software, and you can sell that at $100. So it's just your cost of your employee and maybe a couple of laptops and possibly a server. But if you have to make a factory and you have to manufacture, you have to buy cost of goods, you have to buy a lot of raw materials to make what you're trying to sell, that can be different. And if competitors enter your market, it can push down prices and it can affect your profit margins, which affects the value of the company. Next is what's your return on equity, or your return on the amount of money you invested to start your business. So what is it today and what is the potential? It's always important to understand that the value of a stock can change dramatically if the return on equity can rise over time. Because as an investor, you're investing in the equity. So if they earn 10% on that equity today, but earn 20% on it in the future, then it becomes a lot more valuable to you as the owner of that company. Last two things I want to talk about: your management quality. Is the management team also owners of their business? Do they own the stock in the company? And what are their goals? Are they trying to raise the share price, which is exactly what you want to do as an owner of the company? Many times you can see companies like, or company presidents, they list their company, they get rich quick. They really lose their desire to push the company ahead, looking toward the future, really taking it to be bigger and more valuable. And that's something we do when we visit with management, to really try to understand what their motivation is. Lastly, valuation. It's really important to understand how the company is valued, both versus itself, how did it trade in the past, and how it's trading versus its peer group, what its competitors are trading at, and then to try and forecast how much this company will earn per share in the future. Because sometimes it could be earning $1, but they're coming out with a new product that could really drive sales through the roof. Take for example, an Apple iPhone. They come up with the next generation of iPhone, and they put an attachable on it, and they introduce the iWatch at the same time. Earnings per share can go up by 30-40%. It becomes a significantly more valuable stock over a 3 to 5 year period. So understanding what's going to change in the future, how is that going to impact earnings per share? Those are some things I look for as an investor. Flip over to the next page. Just a couple of examples. The first one is Google. You can see over time since 2012, I think the green line is the share price, the white line is the earnings per share. And can any of you venture to guess what's driven earnings per share over the last couple of years when you've seen it really tick up? Any thoughts? I don't want to waste time, so I'll give you a hint. So Corona drove a ton of people online, and online advertisements really picked up. So Google, through Google search, is essentially the biggest online advertising platform in the world. The second thing that's really taken off is YouTube. So YouTube has become a massive advertising venue for Google as well. So earnings has really picked up, and you can see the share price has gone right up with it. The next example is on the next slide. This company is Boeing. So things were going really quite well from 2012 until 2018. And then two things happened. First, which you all know about, is Corona, which decimated both domestic and international travel and demand for airplanes as a result. And so if nobody's buying new aircraft, Boeing's business and earnings, which is the white line, fell through the floor. They were earning $15 a share, and it dropped down to negative in the last year. The other thing they had was some issues with the 737 MAX, where two deadly crashes happened. This was a big launch of a new product for them, which was really supposed to help earnings, but there were issues with the design of the plane and the software associated with preventing crashes. Unfortunately, two big crashes and a substantial loss of life, and a lot of reputational damage to the company. And as a result, earnings have gone through the floor, and you can see what happened to the share price. It's fallen from $450 to less than $200 today. So this is just another example of how share prices move with earnings, and trying to understand what the impact of incidents are on those earnings. How can it impact your investments? So last slide. I believe I have are the three books that I was talking about at the end of Moma's presentation. These are three really good books that I'd recommend for anyone. They might be a little bit dated right now, but the first one, Stocks for the Long Run. Jeremy Siegel is a very famous business school professor at Columbia University in New York. It's really about long-term growth stocks. Very, very well-written book. One of the best books I read. Common Stocks, Uncommon Profits by Philip Fisher is also very, very well-written book with a lot of very thoughtful points. And the last one, Peter Lynch, is from Fidelity Investments, and he helps simplify the investing process and really makes it easy to understand in terms of what stocks are, what owning a piece of a business is, but also really studying what you're buying so you know what is going on with your investment, and you have faith that this company is going to perform like you want it to. So there's some really good lessons in all 3 books, and I highly recommend them. With that, that concludes my presentation. I'm happy to take questions.
I ask a question, like, do you encourage like for us senior high school student being a speculator for play the invest for short term?
Absolutely not. That's exactly what I was trying to tell you. No, because it's very hard to predict what's going to happen in the short term. And if you can do it consistently, you're amazing. I've got no idea what you're doing, but great. Good luck to you. One thing I do have faith is my ability to invest over the long term, picking stocks that are generating good returns, have good products that grow over time. One of the things that I put in place over a long time is, what products are my kids really using a lot of? So some of the stocks I bought over time are Nike, Disney, and essentially they've paid for a lot of the products that I was buying for my kids. Because they were using so much of these products, and all their friends were talking about them. And, here we are signed up for Disney Plus now. They're still buying Disney or Nike shoes. So understanding what you're buying and having a strategy for generating returns from these assets is really important. With short term, there's a lot of transaction costs associated with short term. You have to pay short term taxes on it. Tax rates on short term investments are higher. So it deteriorates your total returns. So it's just harder, and the frictional costs are higher.
Okay, thank you.
Yep.
I have a question. So earlier on in your presentation, you talked a little bit about how you had been saving for 18 years for your daughter's kind of education and how that was beneficial. Yeah. As a high schooler, I think most of us are in the range of like 16 to 18. What would you recommend we start doing at this age in terms of savings for our future?
Well, that should have been done by your parents, not by you. Because at one, you're not a very thoughtful investor. So, I don't know what advice I give to your parents right now, but what you can do is certainly learn about investing. And I don't know, again, it depends on your nationality, what you're able to do in your particular country about being able to open up an investment account. Certainly your parents, if you're an American, they have educational savings accounts. If you're a Japanese, there are educational saving accounts called NISAs that they can open up on your behalf, and you can help choose what investments they can make for you. In NISAs in Japan, you can buy individual stocks, you can buy funds. But getting started early in your investing career, as I said early on, all of us are battling against time. And I guess the faster you start, the brighter the future is.
Thank you.
Sure. I have a question. Previously, you compared various types of investment opportunities, such as stocks, cryptos, gold, and one of the things you mentioned are bonds. And you said that they typically tend to have a 6-7% return rate, or they can be even.
No. So the 6 to 7% are sort of high yield bonds, and those are higher risk bonds, typically corporate bonds.
Corporate bonds, yes. What I wanted to ask specifically are the war bonds that were issued by Ukraine at a return rate of 11%, and they managed to raise almost 300 million, I think. Do you think that that's an investment that's worth the risk for the yield that it provides?
Really difficult question to ask because you're having to gauge the sustainability, their ability to repay you as an investor. Now, there are so many questions that go into that answer that me being a specialist in Japanese stocks is not capable of answering, because obviously they're receiving a ton of support, but they're also under attack from a very powerful army that continues to encroach upon them and is destroying their infrastructure day by day. So if if something happens to the government, if something happens to the infrastructure and affects their inability to pay, those bonds become worthless. So that's something for you to decide, and you have to determine that risk. I'm not in a position to say.
Okay, thank you.
Yeah. Anything
I have
else?
a question.
Yes.
What sort of like subjects or internships would you recommend taking if you want to go into like this sort of world? Like,
Sure. Good question. So one of the things that we look at Fidelity is whether or not an individual has had investment experience themselves. So I highly encourage you to start understanding the stock market, understanding the world of investments. And it's great to see that you're involved in this club. You know, there's so many smart people in this industry. So many books have been written on the investment business that there's a lot of material out there. And so I highly encourage you to do some reading to familiarize yourself with that. If you can get internships in investment companies, in banks, to better understand the world of finance, it's incredibly valuable, both for your own understanding as well as for potential job opportunities. So my company, we're hiring an undergraduate intern from a Japanese university this year. I know a number of other companies around town that are looking to hire interns as well. It's a great opportunity for you to learn about the company as well as the company to learn about you, to possibly invest in you in the future, potentially hire you for a job. Yeah, the biggest and best thing you can do, if you can find that opportunity. It's hard. It's a little bit easier as you move further down your educational experience, up in your experience level in higher education. But if you can grasp an opportunity some way, it would be immensely beneficial for you in the future.
thank you.
Sure.
I have a question.
Yes.
Previously, you talked about how, for example, a crisis like a COVID-19 affected a company like a Google, and our possible future crisis is invasion of Ukraine. So what do you think about which companies or type of companies or sectors will be affected positively by this crisis?
It's really difficult to say, but we've seen some of the impacts in the commodity markets. Things such as, again, it's interesting because Aisha asked me initially to talk about how sanctions would affect the investment world. And sanctions that are being put on Russia by much of the Western world are affecting markets in many different ways. And it's affecting transport, affecting air travel. Airplanes that used to fly over Russia to get into Europe are being impacted. Many of the commodity markets. So Russia is a big supplier of oil and natural gas to both Europe as well as Asia. And prices of those things are rising significantly. So it's benefiting those companies that hold those resources, that are producing oil, but don't have any exposure to Russia or Europe. So one example is a company in Japan that produces oil both in Indonesia as well as in Australia, and they're benefiting from much higher prices, but they don't sell to any dangerous region. So they're benefiting immensely because of the spike in prices. Same with the big US oil companies, because they hold these resources in safe areas, whether it be in the United States or in the Middle East, and it's totally out of Ukraine or Russia. They have no exposure there. So again, this will change over time. Again, the situation in Ukraine is absolutely disaster, human tragedy, but it's affecting markets in different ways, and that will change over time depending on how it plays out, which, again, it's a terrible thing.
Thanks.
Anything else?
Okay, well, if there are no other questions, Mr. Newrider, thank you so much for coming to speak with us. It was really informative, and we have a lot
Great.
to learn from that. Thank
Great.
you so much.
Let me know if there's anything else I can do. Appreciate
Thank
it.
you.
All right. Bye-bye.
Thank you.
Thank you.
Thank you. Bye.
Thank you.
Okay, with that, should we conclude? Okay. With that, we would like to conclude the 2022 International Forum. Thank you so much, everyone, for attending and staying engaged. Hopefully, we have a lot to learn from our speakers today, and we can apply what we learned to our future, and hopefully it increased our interest in the finance industry a little bit. Thank you.
Thank you.
Thank you very
Thank
much.
you, everyone.
Thank you very much, everyone.
Thanks.
Um,
Thank you.